Good afternoon and welcome everyone to today's US markets update and bulls versus bears. Great to see so many on today's webcast. My name is Kelly Meng, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with our portfolio managers Stephen Lyle, Chris Wallerman, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the question and answers tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Thank you, Kelly. Today's title of the presentation is NA, and what that is referring to is that when companies provide guidance, they will provide typically a range. And a company with very predictable earnings like Procter & Gamble will have a narrow range, and companies with less predictable earnings like an auto company or Boeing currently would have a very wide range of expectations. And when there's an economic shock, what we've seen in 2008 is companies withdrawing guidance. And the withdrawal of guidance is a reflection of the uncertainty in the projected earnings and should result in a discount in the price to reflect the risk in the potential earnings. What should be happening is that each of these companies will have financial models which help them to put inputs in of their costs and sales prices of foreign exchange, etc. And if their inputs have a wider range, then their forecasted earnings should have a wider range output, but they should still be able to make some projections, although a very wide bell curve around the average estimate. But a lot of times you get companies withdrawing estimates, and I think that practice will stop. But it has not stopped with strategists. As we enter into the end of the year, we're starting to get estimates for the following year from Wall Street strategists, or the bulls and the bears on Wall Street, the major strategists, and we have a number of strategists saying that their estimate for next year is not available, and that should be a reflection of risk and represent a discount that the stock market should be trading at. However, we're not trading at a discount, we're trading at a pretty big premium because of the low interest rates are encouraging people to borrow money and buy equities. So NA refers to a lack of estimates for the S&P 500 closing price for the end of next year. So that's not flipping. So this month was the strongest month for the stock market in, I had the month, but in 10 years or something, 11% on the S&P 500 for the period. We go from the weekend closest to the end of the month because I write on the weekend closest to the end of the month, so it's not always the month precise. Earnings estimates for 2021 are up 1.1%. That pushes the price earnings ratio, the forecasted price earnings ratio for 21 up 10% to 21.3. To give you some perspective, at the top of the dot-com bubble, we did not have depressed earnings as we have now. Earnings are now 20% below where they were the prior year. We were at peak earnings cycle at that time, and we got to 25 times forecasted earnings. So if you take a 20% discount off of this because we're in trough earnings, then the PE would be below that 21 level. But Goldman Sachs, for example, is forecasting a recovery to at least last year's levels. The 10-year Treasury yield did increase in terms of basis points. The yield is up to 86 basis points, still very low, indicating that there is a better probability of a recovery next year, but there is no risk of inflation. The very low interest rates encourage, of course, the government to borrow money, and as the government borrows money to provide stimulus, hopefully more in January, or it provides an opportunity for corporations to borrow money to buy stocks. And that goes back to a report that we wrote quite a while ago called the Virtuous Cycle, where we talk about M&A being fueled by debt and that causing stock prices to continue to go up. One of the reasons we were bullish, very, very bullish about 2 years ago. But the low interest rates provide a good source of capital, a very very cheap source of capital for companies to leverage up and make acquisitions. And we've seen quite a big increase in the M&A activity, which has benefited Goldman Sachs, our investment there. Companies are still providing guidance, but less guidance. Strategists should not be making NA predictions. The strategists have a job. And if their predictions are a wider range, then let's see the wider range. Let's see what comes out of your financial models and see what the range in expectations is. Because if we can see that bell curve and we can see that range, then we can take an estimate of how much risk there is in the market or the variable outcomes. But they should not be making NA predictions. Maybe it's just a little bit too early for them, but last year at this time they were all out, and this year they're not. So that's indicating that you got a bunch of chickens running the strategy departments. Speaking of chickens, did anyone see the Just Eat announcement in Singapore today?
Just Eat.
Just Eat, yeah, announced that they've approved lab-produced chicken for sale in Singapore. So you can take those cells, grow your chicken in the lab, and you don't harm animals. But that was approved today in Singapore. Nobody, interesting of these strategists, when we go through the bulls and bears and what the arguments are, nobody's even talking about foreign earnings. And half of the S&P 500 earnings, it's a little bit less than that now, but about half of the earnings for the S&P 500 come from overseas. For example, if you look at McDonald's, they get about 2/3 of their earnings in the United States, about 1/3 overseas, but those overseas earnings are growing at a much higher rate, so they get a higher valuation on the foreign earnings than on the domestic earnings because of the higher growth rate. And so you'd say that McDonald's, which has about 10% of its assets here in Australia, should be very sensitive to foreign exchange. And there are some parts of the world that are not recovering as quickly as the United States. Of course, the Trump policy of staying open and keeping the economy open is going to keep that economy moving compared to other countries, such as where we've got new lockdowns in France and in Germany and in the UK, and we'll talk about Australia a little more later. This is the relative value model, and Kelly, are we monitoring questions? We're encouraging questions, even though you're not here today, and I can't, see you raise your hand. I would like to encourage people to participate and ask questions as usual. Kelly, have you got a way of monitoring questions?
Yeah, we'll see it.
It'll pop up? Okay. The market is a rocket this month. You see oil up 40% on the far right of the screen over here. And we've got a big increase in lodging, a big increase in financial institutions, even chemicals up 20%. So a big broad-based rotation into COVID recovery stocks. Now, we've had many people, particularly Thomas Lee and some others, Thomas Lee from Fundstrat, the ex-JP Morgan strategist who started his own business, who's the Bitcoin enthusiast, saying that there will be a rotation into epicenter COVID stocks. So we've seen this big run up in all those cyclical stocks this month that it suffered. That's the hotels, that's the cruise lines, the casinos, and the autos, and some of the deep cyclicals. So a big rotation this month coming off of the bottom. One strategist says the top 5 FANG stocks are now 25% of the market. Of course, in January, we talked about them going from 18 to 22% of the S&P 500, but the FANG's now 25% of the market. And what they're saying is that the other 495 stocks in the S&P 500 are only up 5% for the year. So there's plenty of room for a rotation. Some strategists would say it's too early. We would say it's too early. But the big movers here this month, Coty on the upside, of course, they're the New York-based fragrance company trying to shift into the higher end brands with a lot of sales through airport duty-free shops, has had an upgrade from Citigroup and a turn up in their earnings. But the company's been going down for 5 years. To see it up 137%, like how would you know that they were going to hit that bottom and have that big bounce? Similarly with Sprint Aerospace, making parts for Boeing, for General Electric's engine business, and for Airbus and for Boeing. Again, the 737 MAX downtime has caused a lot of pressure. The stock spread has been down severely and has had a big bounce. So what we're seeing here is also bounces in those U.S. domestic shale producers, Occidental, Apache, Devon, Marathon, big exposures to the Bracken fields or the fields in Texas or in South Dakota. Macy's, again, a bounce stock. Alcoa, a bounce stock. Carnival, a bounce stock. Allegheny, U.S. Steel, bounce stocks. Boeing, a bounce stock. And ConocoPhillips, but up 50% for ConocoPhillips is a gigantic move. So we've seen some very big bounces off of some severe lows. And if this rotation into the COVID epicenter stocks, or the ones that have really been hurt badly, the heavy balance sheet companies with cyclical exposure to hotels, et cetera, there could be a big bounce. Of course, OPEC is having their meeting and that fell apart. They'll have to reconvene to see if they're going to pull back on production. And on the downside here, a couple of gold stocks which had been safe plays for a while, Barrick and Newmont down. Alibaba's down for particular. Andrew, why is Alibaba down? Because they had the Ant Financial. Just trying to spread this around a little bit.
Yeah, so Alibaba have about a 30% stake in Ant Group, which was going to be the biggest IPO, which sadly Jack Ma got a little bit lippy around the financial regulation industry in China, and it was quickly pulled from underneath them. So that's kind of put them in the penalty box because of that.
Shows who the boss is. The boss is Xi Jinping, right? So you know, even if you're Jack Ma, you don't go talking about the performance of Chinese banks without being called to Beijing. Regeneron, Reckitt Benckiser, do you guys want to comment on the, because I don't remember what happened to Biogen. That's a joke. That's a joke. Do you want to explain what happened to Biogen? Because we did that last month.
Yeah. Was this the Alzheimer's drug that failed?
I can't remember. That's
yes. Yeah. Another. Biogen has bounced around on a number of drug developments that failed, and this is the most recent one. Alzheimer's is a very hard disease to treat, and they still don't have the.
And their drug failed FDA approval, so that stock is down. And some others that have done very well have pulled back. Danaher is amazing. They're, of course, bought the dental business from GE, and Larry Culp went from Danaher to GE to run GE, and he seems to be doing a good job there. But they bought the dental business. They're into a lot of medical supplies. The stock's up 500% in 5 years or something. It's been tremendous. So to see Danaher and Thermo Fisher and Biogen pulling back. Baxter had a problem with heart valves. So aortic heart valves, Boston Scientific had the problem with aortic heart valves, and that caused a run up in their competitor, Edward Life Sciences, but didn't have as much of an impact on Medtronic. Our investment, of course, Mick Jagger chose the Medtronic heart valve. There's a question. Good. I'm glad we have a question. Kelly, over to you. The audio isn't picking up very clearly.
So
Thanks for that. We'll when people speak, we'll come forward now. Okay. Thank you. Okay. Speakers at the end of the table. Yeah. Okay. Okay. Well, when they speak, we'll bring them forward, and I'll give them the COVID handshake. I'm going to start this month by talking about the Fortrend view, rather than going through what Goldman Sachs is saying. And well, actually, in the report, I wanted to put the Fortrend view first. But when talking today, I want to give you the background of what the other strategists are saying. Then I'll come back to how we take from what they're saying and come to our own conclusions. So the bulls at the moment, the biggest bulls at the moment, Cantor Fitzgerald is actually quite a large firm that started mostly in the debt markets. And was at the top of the World Trade Center for 9/11, decimated because of that. But very solid firm. They're taking a very, very bullish view on the market. Goldman Sachs, David Costin, you know, we got a lot of respect for David Kostin. He's made some very good calls. He went bullish in 2003 when we went extremely bullish. And then he went bearish, and he's made some very good calls. JP Morgan is not giving an estimate, and we're not going to cover him today. We're going to go divert to Thomas Lee and follow up on his comments about the commodities and the epicenter stocks. Stifel Nicholas, no estimate, but very bearish commentary. And so we'll go through Barry Bannister's commentary on the negative side of the market. Savita Subramanian from Merrill Lynch is really a technocrat. She gets into a lot of detail, a lot of modeling, a lot of detail, a lot of very interesting things, but she gets too far into the weeds sometimes, and some of her intellectual ideas are not very practical. And Citigroup, Tobias Levkovich on the negative side of the market. On the bull side, Eric Johnson is new. He came across from Deutsche Bank. He's a rookie. And as a rookie, he's made a very, very bold call, being the most bullish strategist on the street. And his call is very simple, as opposed to Savita Subramanian. He says that the VIX has been high, got up to 83, has come down, and is still very high. So, Chris, would you like to explain the VIX and how the Vix Index works?
Sure. So it's also known as the fear gauge, but the Vix Index measures the pricing of options with short-term expiries, options over the S&P 500 index. And when there's a perception of significant moves, the price of those options, puts and calls, increases. And so it's actually a coincidental indicator of investor perceptions around volatility, what they're willing to pay to either speculate on the upside or downside, or to hedge. And so we tend to see that the VIX is inversely related with the index performance, in that it tends to rocket when we have a shock event.
So there is a correlation. If the VIX goes up, the market goes down, because when the VIX is up, it reflects risk, and the market goes down because you price in that risk. So his basic premises is that the VIX is above average historical levels, and it's going to go back down. And he says, however, in the next short period, we should have a pullback in the market. One of his reasons is that there's thinner volume during the holiday period, and some selling programs could have a bigger impact on the market. So if there is a pullback, it'll be in the next 4 weeks, and that'll be a good opportunity to buy. And I like that sentiment, but I don't know that I would place my faith just on a reversion to the mean for the VIX index. I don't think that's a good overall strategy. We tend to look at a lot more fundamentals than that. I think for a freshman or a first-year out analyst, strategist, 4,400 is a very gutsy call. He's going to make or break his career on this one. We would also like to refer to Savita Subramanian, who we call a technocrat and probably too detailed. So it's interesting the contrast of the gutsy gut call, instinctive recommendation from a technocrat like Savita Subramanian. David Kostin, also very bullish on the market, says that the vaccines are a game changer. And he's really calling for the economy to revert back to where it was as soon as the vaccine is released. Now, of course, we've got 20 million vaccines coming out, possibly by the end of the year, going to frontline workers in healthcare and elderly homes. But I don't see it just bouncing back the way he does. The economy will normalize. Rates will rise, but they won't rise too much. Now, of course, rising rates is going to be really good for our investment in Goldman Sachs. So anyone with in the banking industry is going to benefit tremendously from an increase in interest rates, and also an increase in economic projections. But vaccines, he says, are much more important than the election. Now, Steve's, really likes following politics very closely and is the divert there. But there was this concept called the blue wave, which was where there was an expectation that the Democrats would not only get the presidency, but would also get some more control over the House of Representatives. So Steve, would you like to talk about the blue wave and why the election is? Maybe you can follow through on some of David's comments about the important issues.
Yeah, I might leave it with you for David. But yes, I think that this outcome with the election, as far as the market is concerned, it was the best of all possible outcomes, which is a divided government. Biden will be the next president, in spite of what Trump continues to say, and the Senate will most likely remain controlled by the Republicans. But that remains to be seen. There is a runoff in the state of Georgia for the 2 Senate seats there, which are currently held by Republicans. And in order for the Republicans to maintain control of the Senate, they have to win at least one of those seats. So that runoff is on January 5th. And between now and then, there's going to be a huge amount of money spent on these 2 campaigns. They're talking about billions of dollars that will be spent the next month on both parties, because this is pretty important. But nevertheless, I think that the outcome of the election was not totally satisfying for those people who absolutely despise Donald Trump, because the Republicans really won everything down ticket. They gained 11 seats in the House of Representatives, and they're going to maintain control of the Senate most likely, and they gained a couple of state legislatures. So it was a big win for Republicans across the board, except for the president.
Thanks, Steve. So David Costin is calling for earnings to bounce back 30% from the 20% reduced rate in the current year. He's 13% above consensus, so his forecasts for earnings are well ahead of everyone else, and as a result of his forecasted earnings, he's very bullish. He's looking to buy growth stocks, and he's looking at companies' capital expenditure budgets, and he's looking for those companies which are willing to expand quickly to come out of this. So that's not just the FANGs or the Shopify and Etsy's of the world, not these software companies, but he's also looking at industrials which are spending money to grow in the current year. So he's saying that a vaccine will normalize the economy. I just don't see it. I just believe that if you destroy a business, you don't just reinstate the business. If you have skills atrophy because people aren't working, they don't just automatically get back to where they were through osmosis. Hotels and cruise lines, he's saying, will benefit most. Could be, but it's not going to be as fast as he thinks, in my opinion. Democrats will not have the power that Trump had 4 years ago. Remember when Trump came in, he had both houses. So he was able to put in tax policies, cut taxes, cut regulation. He brought around the trade negotiations. He was able to get stimulus through. The Democrats will not have the power that Trump had 4 years ago. So we've got this watered down policy. It's unlikely that there'll be major changes in tax, unlikely there'll be major changes in regulation. So a divided government is good for the markets and a reduced risk. And I put the there because when is an ineffective government good for markets? In this cycle, it is. Right now, the view is that because the Democrats can't do much, is good. Normally, you'd say, well, if they can do a lot, that's good. But in this cycle, it's better that they do less. That's the view of the street. Techs are 25% of the market, and the other 495 companies that did not go up so much last year, the FANG stocks, will benefit. Healthcare is at its lowest valuations in 40 years. And the biggest risk in healthcare is policy risk. With a divided government, it mitigates policy risk. We're overexposed to healthcare. We're very happy there, and we're very happy with the divided government, the reduced policy risk with the healthcare companies. Interest rates will support those growth stocks. More importantly, will support the banks. Companies with big balance sheets could be the risks are that you get a real bad surge in COVID over the winter, that you get a small stimulus package, and in which case you weaker than expected economic results. You have big balance sheet companies exposed. The forecasts are dependent, his forecasts are dependent on a stimulus package, and he's expecting the industrials to benefit from that stimulus package. So if it doesn't come through, then he's going to be wrong. Healthcare lagged coming into the election, and there is some concern about regulation, but less concerns than before. Moving on to Thomas Lee, there's no questions coming through. Thomas Lee, you know, is kind of an outlier because he left JP Morgan and went less institutionalized than others and was an early proponent of Bitcoin and cryptocurrencies. He continues to say buy Bitcoin, even though it's up, I think, from to about $19,000. It's been surging recently during the pandemic as a safe haven. And he's saying buy other commodity stocks. So buy hard, buy soft commodities. There's a reflation trade in the pipeline. So you really want to get into those cyclical stocks and own things such as, let's get to what he's, epicenter stocks, consumer finance. So some of the worst hit companies were Discovery and Capital One and Synchrony. And some of these consumer finance stocks were hit the hardest. So he's saying buy those, buy gaming, buy resorts, buy cruise lines, buy airlines. I think it's a bit early on that one. I'm not prepared to do that. And appliance manufacturers. So appliance manufacturers had been doing better than others because the low interest rates have been allowing people to support the housing market, buy houses, and along with houses comes furniture and appliances. But he's also calling for some appliance manufacturers. They're parts of bigger companies and hard to take an exposure to, except through New Zealand or something. Is there a white goods company in New Zealand that you can trade? Yeah. But Discover, Target. And in the US, Target's different than it is in Australia. Best Buy, AutoNation, Snap-on, and Borg Warner, Mosaic, the fertilizer company, General Motors, and Flowserve. On the bear side of the market, Stifel and Nicholas's Barry Bannister is saying it's just way too early to make this rotation call. So as much as we had this big 11% move in the market over the month, it's just too early to make the call. He's warned against a value rotation in an unsettled world. So it hasn't settled, and we don't have these estimates out, and there are wide ranges in expectations. We have a high, what we call a standard deviation off of the average on the bell curve. So risk is not priced into the market, but you know, there's a lot of leadership in the FANGs. Rotating is premature. Be careful what you wish for. Populism, currency debasement, and a greater role, federal role for the GDP is creating a lot of geopolitical conflicts. So one of the major concerns we have is the really galvanized, the world galvanizing in East versus West, and the China issue, and we'll come back to that. But I don't see Biden as being as anything changing. I think things will only become more galvanized with the U.S. versus China. Near-term risks: slower economic growth, delayed fiscal moves or a delayed stimulus package, a flatter yield curve, and cuts in earnings estimates for next year saying that they're too high. So it's really saying this is not happening as quickly as you might think it would otherwise. And a divided government may reduce the impact of a stimulus package, and there might be more arguing over that. It'd be nice if the government got together and provided some stimulus, but even if it does, the levels of debt are getting to be very high, regardless of the cost of servicing those debts being very low. Value versus growth trade said the secular leadership is not going to last. It's just not there yet. Let me move on to Savita. I'm not getting many questions here. I'd like to take some questions if people are able to type something in there. Savita Zubermanian gets very, very detailed technocrat in her models. And so much so that a lot of the minutia is impractical. But it's good detailed thinking. But she says more room for a tech run this year, but go down a level from the FANGs to software, go down a level to enterprise companies like Cisco and Hewlett-Packard Enterprise and some of the likes. So take a step down to semiconductors, which are going to be cyclically sensitive. So she's saying the FANGs are overcrowded. We would agree, 25% of the market. I think they are heavily, but we're not selling our Google shares. Technology is secular growth, but it has a cyclical price tag. Relatively unloved companies in enterprise tech, rather than owning the overly loved FANG stocks. Semiconductors are really her interest, the space she's most interested in. And of course, we have the exposure there to, Kelly, would you like to read that? I like this question right here. I really like this question, but I'm going to let you repeat it.
So Marcus said, loving the presentation. You guys are awesome. Thank you.
Thanks, Marcus.
Any opportunity to get exposure to the electric car sector growth other than Tesla, which seems crazy expensive?
Well, that's a good question. You know, Marcus, we don't think of Tesla as an electronic car company. We think of it as an energy company that uses cars to distribute power. So think of it like Bitcoin in a way that it's decentralized energy. If you had a car in the future, you would drive your car home at night, you'd plug it in and you'd power it up. And then you drive into when power is cheap at night, then you drive into the office and plug it in the office, and then you download that power to the network during the day. So it's really an energy company that has cars as its means to distribute the energy. But can someone else talk about electronic vehicles in general and some of the stuff coming out there?
One sort of oblique approach would be to invest in a lithium miner, and there are a few that are available. Albemarle, Livent is one with the ticker LTHM. That way, it's sort of agnostic as far as the brand goes, but their material is critical in the battery technology that's being developed.
Maybe one of the things to add, just as a maybe just as a more pure play, slightly at the higher end of the risk spectrum, a couple of Chinese companies that are listed and actively traded in the US: Li Auto, XPeng, but and NIO, of course, NIO is the ticker. The one to probably keep you up the most at night is Nikola, NKLA. They just lost the deal with GM, so a lot more risk at that end of this curve, but a couple of names there.
So it's a sector that that is the future, and it is about distributed power, and it is expensive now in Tesla, with Elon Musk being richer than Bill Gates, I understand, right? Yeah. He's surpassed Bill Gates. So maybe maybe Warren Buffett will start playing bridge with Elon Musk instead of Bill Gates. I'm going to go now. Those are the strategies. I'm going to go back to what we're summarizing from or concluding from what these strategists are saying, and some of the Fortrend, some of our thoughts on things. So I'm flipping back. Free money. When you have free money, you borrow it, and your cost of servicing that money is very low. So there's very little cost of borrowing, but there's a huge risk if interest rates go up later on. Government debt around the world, as we wrote in our debt report in January, I think it was, or February, is surged to huge levels. Corporate debt is being used to buy equities, and we have this virtuous cycle where there's more M&A because companies need to use that money. They're being pressured by shareholders to use that money to make acquisitions and to build businesses. So you have a lot of leverage at a very low cost, which is increasing debt around the world, and that risk is not carefully considered. So this free money is a problem, and low interest rates will not last forever. Now, in 2008, we saw this financial crisis, and it was largely blamed on banks. You know, we wrote extensively about how the U.S. was running a deliberate trade deficit money was accumulating with the trading partners. For example, China would have $40 billion a month. It would have to invest back into the United States. So we would buy widgets from China. The US would buy widgets from China. China would receive US dollars, and then China would have to buy a building or equities. And then it became that they had to buy things where they did not have economic influence, such as exchange traded funds and then bonds. So a lot of the problems from 2008 were not really the banks, were not really the home lenders. It was really the US government running a trade deficit and forcing foreigners to accumulate US dollars that they had to invest back into the United States, causing bubbles. Now, what I want to point out is that at that time, General Motors had a finance division called GMAC, and you could have thought of General Motors as a finance business that sold loans by having cars. It's like Tesla is an electric company that has cars attached to it. General Motors was a finance company that had cars attached to it. The cars were the ways, the means of making loans. And interestingly, we're coming full circle here. General Motors has applied for a banking license this month. So I just want to show you that these things come around in full circle. The big wheels keep on turning. That's a song. Proud Mary, if you don't know that one. Does anyone recognize that one? Yeah. Proud Mary, the big wheel keep going. Actually, in that song, it refers to a riverboat, a big wheel on the back of a riverboat, but I'm just trying to look for questions here. No more questions. Okay. Politics. We had not seen a market more impacted by politics than the Trump administration. He was a market mover. And what we're not going to see with Biden is we're not going to see a market mover. With George Bush, after 9/11 and Iraq, the US had a bully tag. And so you bring in Obama, who was bland, did very little. I mean, it was 8 years of kind of like meandering along with relatively low growth, trying to work off some debt. But he was trying to bring peace to the world and a good image for the United States. So you go from a bully tag to a bland tag. Trump starts a war, and interestingly, if you go back to Reagan and then George H. Bush, and then George W. Bush, the Republicans tend to start wars. Trump did not start a hot war. He started a cold war, but he was certainly seen as a bully around the world with America first. Biden is now surrounding, and much like George W. Bush surrounded himself with all of Ronald Reagan's people, Biden is going to surround himself largely with seasoned Democrats but they'll be limited in what they're able to do by the Senate. Now, we've seen a lot of appointments coming through, Janet Yellen, and he's going for a very ethnically diversified group of women to support the Democrats in this round. So maybe it's not the way George Bush did it in bringing in all the people that worked for Reagan. Maybe he's got a new administration coming through, but we're certainly going to see the Democrats limited by in their scope by not having control over the Senate. And Steve will say you still have the runoff in Georgia, but it's highly likely that the Democrats will not get both houses and will not have that. So Biden will be nice. Now, for those of you who haven't seen, he broke his leg overnight playing with the dog. He's kind of old, so Steve, he's the oldest president ever elected. So Reagan in his second term was 74, yeah. And Biden is 78. So Reagan was the oldest president previously in his second term at 74. Biden at 78. That means Kamala will have to help out a lot. So just expect that. China is going to test Biden's mettle. That's the biggest issue going on in the world right now. I think Trump handled ISIS and some of these issues in the Middle East. They're not as important. The big issue now is China. So what are the key issues in China? He's going to have to take a tough stance on trade. He's going to have to take a tough stance on intellectual property. He's going to have to take a tough position on 5G, on Huawei, and he's going to have to take a tough stance on espionage. Of course, every president stayed at the Waldorf Astoria Hotel until the Chinese bought it, and then Obama said, I'm not staying there. And so it's no longer the go-to place during the United Nations meetings in September. There's going to be no relief for Huawei, and he's going to protect US semiconductors. I think that's a problem for AMD. Now, quantum computing would speed things up so much that it would force a rethinking of how encryption works today. So encryption today is done in a way that could be undone by quantum computing. So this AMD joint venture in China, where they're not giving away IP, but assisting the Chinese in developing their own IP for quantum computing and for supercomputers, will come under pressure. We're concerned about that. He will do some things that will please the world, like rejoining the Paris Accord and continuing to put pressure on the Chinese to scrub their coal plant exhaust, and will rejoin WHO, the World Health Organization. He'll probably step back from the brinksmanship on Hong Kong. I think the Uyghurs in the West, in the far West, who are the Muslims who have been, they're trying to make all the same as the Han Chinese. There will continue to be the Chinese putting these cultural demands on people within their boundaries. And there's a risk in Taiwan. Of course, Taiwan is not recognized by most countries in the United Nations as an independent country, and China certainly thinks of them as their own. The 3 T's are important: Taiwan, Tibet, and trade. Tibet is sort of a done deal. Those people are largely washed into the Chinese culture now. Taiwan is still standing up for themselves, but trade's going to be an issue. So the South China Sea is going to be the hot point. The easy points for China will be to build trade routes, their Belt and Roads initiatives, through Burma and through Pakistan, and to access Africa and the Middle East through those routes. But the US is not going to be able to concede the South China Sea. So the biggest risk for Biden right now is to be tested on a hot event in either Taiwan or the South China Sea. And the US will further align with what are called the Quad talks. That's India, Australia, Japan versus China. And it's the ganging up on China by other countries to try and solidify a presence, particularly in the South China Sea. China, as I say, will push through Burma and Pakistan, get those trade routes open, and they will continue to work with countries that the US won't work with, where there might be dictators or bribery. So China doesn't mind bribing political officials, where in the US you can't do that. So there will be a Chinese takeover, continued takeover in the Middle East and particularly in Africa. So the war will continue, and it'll be not only the bats versus the fangs. Australia, of course, is tied to the US for defense and is overly exposed to China for economics, and these wine wars are ominous. I wrote this before the repugnant comments. I think that the Australians, announcing that they've murdered 39 people in Afghanistan with the tweet by the Chinese official is a sign that things are just going to escalate. The suspicions are spiraling. It's ugly, and Australia has some exposure. Students won't want to travel here, and there'll be long-term damage to our education and our property systems here. The Australian government can afford to borrow and stimulate to support the economy while Australia negotiates with other Asian nations to buy Australian exports, but now at discounted prices. So there'll be a diversity away from China towards other Asian nations, and that'll take some time, but things will be tougher here. I'm not an Australian expert, so let me defer you to your local advisors for more comment on that, but that's my overview. The US economy has a K-shaped recovery. The K-shaped recovery refers to the rich getting richer, the poor getting poorer, and we do not agree with David Kostin, who's predicting a vaccine will cause an economic reversion. It just doesn't bounce back like that. There's been great capital creation in a lot of the FANGs and the work from home stocks, And there's been a lot of great results with companies like, we'll talk about Shopify and Etsy, and Zoom, et cetera, et cetera, et cetera. There's a lot of companies that are really good, but there's a lot of capital that's been destroyed. And there's a lot of malls, a lot of office towers and hotels and cruise lines, et cetera, that are going to not just bounce back. The capital doesn't just fall by 50% and then recover by 50% and go back to a reversion to the mean. It doesn't happen. So there's been real erosion in capital, not in public capital in these big FANG stocks, and there is skills atrophy. So skills atrophy meaning that if you're not on the workforce for a year, how do you get back into the workforce, and why aren't you replaced with somebody coming out of college, et cetera. So the long-term job losses will not be turned back on. However, the velocity of creative destruction is much faster in the United States than anywhere else in the world, and the US is reinventing themselves very quickly. And one of the really interesting spots is in US retail. Now, in retail, maybe I should let one of you guys talk a little bit, but well, you're going to talk about the stock, so let me talk about this. Etsy and Shopify are mobile apps that are effectively shopping malls on your phone. And companies can open up a store in the shopping mall, a virtual store. And what this is doing is giving a platform for building a new brand with a very low barrier to entry. So people who do arts and crafts, it's sort of taking nationalism and taking it to localism and creating a local arts and crafts business for, this one kid I know is just graduating from high school. He's got an online brand to do T-shirts, and you open that store in a Shopify or Etsy, and you go do your silk screen or your shirts or your whatever your arts and crafts are. But it's creating this opportunity for a new generation of people who are retooling and rebuilding to replace the shopping mall. So it's a very interesting business that's going on. They're really offering, Etsy is really offering a listing service and a search engine, but the power in it is the Etsy payment system. So if you go to Alibaba, you have Alipay. If you go to WeChat, you have WeChat Pay. And PayPal used to be owned by eBay, and they let it go. I think that was a mistake, but they let it go. PayPal is doing very well. But Etsy has its Etsy Pay system. So when you sign up to sell stuff through Etsy, you sign up to use their internal payment system. And so we're getting cottage businesses, garage businesses starting up all over the place. And some of them are simply some graphic designer selling stickers, but they're out there doing it. And it does create an opportunity. The investors love it. And I'm going to answer this question after I say this last point. One of the reasons the investors love it is they get immediate gratification. You can see the real-time sales data that's flowing through Etsy or Shopify, whereas for Macy's or for JCPenney or for all the major US retailers, they do not report earnings on at the end of the year, in the end of December, the way most companies do. They report in January, so they have time to take the sales data over the Christmas period and report it properly. So with all the major US retailers, you're getting a January 31st data point. With Etsy and Shopify, you're getting immediate real-time gratification with seeing that data flow through, and the investors are loving that. Kelly.
All right. So Doug has a question. So if world trade will be compromised for some time, US performance will rely on domestic consumption. Are median incomes and savings in sufficiently good health to support domestic growth? On the supply side, with US businesses can be affected by Chinese supply chains being used for political leverage?
I think Doug, it's a good question, and it's what Wall Street is absolutely missing. The trade deficit was up to $70 billion last month, and that's because US domestic economic activity is strong, and foreign purchases of US goods are down because the US is outperforming other economies around the world. One of the reasons it's outperforming economies around the world is because of the stimulus package, which has now run its course and is no longer available. So the question becomes, will there be a new stimulus package to continue to stimulate the US economy, and will it do okay? Now, and then again, we're coming back to policies of different governments. Will the Australian government provide stimulus for small businesses in Australia and keep Australia cranking along? So it becomes a policy issue, and it becomes difficult to predict. The U.S. consumer is, though, reinventing themselves, and as they reinvent themselves faster, I don't know of any European companies that are doing what Etsy and Shopify are doing. I don't know any in Australia, but I don't follow Australia. Does anyone know if this creative destruction in online shopping malls is happening other places in the world? Certainly, Germany's got its delivery companies. You know,
perhaps Kogan would be a poster child of that online disruption. I don't know if they have their own payment platform, but they're a fierce competitor with their online shopping platform, and have a very good reputation for utilising customer data to maximise their sales, especially if you buy a particular product and other users typically buy a complementary product. That complementary product will be shown and advertised to you.
There is a terribly pathetic Australian company called P2P, which owns a bunch of taxis, and they appear to be going bankrupt. And it just blows my mind that a company that's in the delivery business, whether you're delivering people or you're delivering goods for Amazon, has the inability to say, wow, we've got a license to deliver people, why don't we deliver packages? And they can't recreate themselves. But it is very important to recreate oneself in this market. So look to places with a high velocity of creative destruction and the ability to recreate. The rest of the world is largely being ignored by analysts, Doug, and that's exactly what the point we're trying to get down to. Lockdowns in Europe, a lack of data from China is concerning. U.S. trade data showing that the U.S. is strong, the foreign earnings are weak, and in particular, if you haven't noticed, South Africa, Brazil, and Turkey are in dire straits. They have got real big problems in those countries. So not just Turkey, which hits the news, Brazil and South Africa have bad unemployment rates, bad debt rates. It's just across the board disasters if you're not watching South Africa. So we continue to recommend a conservative portfolio. We're up 10% this month. We did outperform even though we had a 10% cash position, which was because of the strong recovery which continues in Viacom and in Viatris. And I'll let the guys talk about some of the stocks that we're recommending. We've got, we're getting down to I went on a little longer than I expected, so let's get it over to Chris and Steve and Andrew and let them talk about the stocks in the portfolio.
Yeah, I suppose it doesn't really matter too much if we go a few minutes over time because this is recorded. So the last few minutes for those that need to leave will be available shortly. Goldman Sachs. I mean, most stocks and sectors had a strong month, and it was very much attributed to this reopening theme. Goldman Sachs and the banking sector have traded in a fashion that's very sensitive to the economic outlook. The yield curve, the shape of the yield curve, which reflects expectations for the future state of the economy, steepened somewhat, and that really influences lending institutions' net interest margins because they borrow with deposits at the short end of the yield curve and they lend for mortgages or whatever at rates that are tied to the long end of the yield curve, and that net interest margin expands as the yield curve steepens. Interestingly, Goldman Sachs, as we have belaboured for a number of quarters, are not a significant lender. In fact, the net interest income is about 12 or 13% of their total revenue. And so it's been curious to us that during the pandemic, Goldman Sachs has underperformed on those credit concerns, whereas some of their peers, the poor performance is perhaps more justified when they rely more on interest income, the flat yield curve, and they have exposure to deteriorating credit at the consumer level and also in the energy space. Some of the very strong performing divisions have been the trading in fixed income and currencies and commodities and equities. That's been persistently strong in a volatile environment. And we'd also point out some recent deal wins at Goldman. They've been the lead manager on some high-profile IPOs this year, and in what is the biggest merger deal for the year, Goldman is the lead advisor. S&P Global has agreed to buy IHS Market in a $44 billion deal announced earlier this week, and it's good to see Goldman again showing some leadership on those M&A league tables. So they've really demonstrated their credentials in recent quarters of having a fantastic track record navigating and profiting from crises, and the stock has approached the book or net asset value this month. That was a persistent discount and one of the central elements to our investment thesis. Coca-Cola, also a reopening rotation trade, and the strength this month was very much driven by the positive vaccine data. The at-home sales remain quite elevated, and the other side, the away-from-home channel, there's increasing confidence that that will recover soon as everything from theatres to offices and restaurants reopen. It's been a story of sequential improvement. We saw back in April, revenue was down 25% versus April last year. Every month has had sequential improvement to the most recent quarter, the third quarter. Unit volumes were down only 4%. The stock remains about 13% below the pre-pandemic level. And to Steve.
Viacom had a breakout month, up 23%, which takes their total return since mid-March, which was the nadir of the market, well above 150%. So we're seeing real recovery. Investors are getting more comfortable with the combined entity. It's now been 1 year since Viacom merged with CBS, and management is now focused. There's a lot less drama in Vanity Fair that's being reported, and they're gaining traction in their streaming division, which saw 56% growth this past quarter. Earnings were $636 million, or rather revenue in the streaming division. Let me just go back there. They're also reducing debt. They're selling Simon & Schuster, their book publishing arm, to Random House Penguin. They're focusing on the core business and on the content and selling off peripheral assets. And we think that makes a lot of sense. It's trading at 6.5 times earnings, still very good value. Electronic Arts had a great quarter, a really excellent earnings result. However, they guided conservatively, and they also announced two interesting things. Firstly, they initiated a dividend, 17-cent quarterly dividend, which is about 0.5% annual yield. And they also announced a $2.6 billion stock buyback. I think investors were a little confused in that the company's not deploying their cash towards, say, acquisitions. Rather, they're returning it to shareholders. But after a brief fall at the end of October following their earnings announcement, we've had nice recovery in the stock. It's now trading about $127 a share. I might hand it to Chris to discuss Viatris.
Thank you, Steve. I'll discuss the 3 healthcare stocks in the model portfolio, and Viatris represents the new merged Mylan and Upjohn business. Upjohn was a branded generic or off-patent drug business within Pfizer. Mylan and Upjohn finally closed the merger mid-month, and this is one of the key catalysts for unlocking value in a generic drug business that has really languished despite some pretty solid fundamentals. And the rationale for the merger is to enhance the global scale, provide a stronger presence in the higher growth emerging markets, There are also opportunities for significant cost synergies, and in an effort to appeal to income-focused investors, there's a real commitment to return capital in the form of dividends and repurchases. And initially, the dividend policy will be to return a quarter of free cash flow as a dividend starting immediately. So it'll be a quarterly dividend that will be instituted shortly. So this is an important step in unlocking some value, and I think the investors are becoming increasingly optimistic about those prospects. The stock traded reasonably strongly after the merger close, and I think as management executes and delivers on those KPIs that they've outlined, that investors will gain confidence in that path, and that Viatris will be ascribed a more meaningful, realistic valuation, trading at a very cheap 7 times enterprise value to forecast 2020 EBITDA. Medtronic was one of the few stocks that reported out of cycle. They had very solid second quarter results as they recover from procedure delays, which were associated with the closure of hospitals and stoppage to elective surgery. Sales for the second fiscal quarter were down just 1.5%, and like Coca-Cola and so many businesses, it's been a story of sequential improvement every month. So sales are approaching the same level they were last year. Their goal is to restore the growth in their heart device business and also diversify into some new high growth areas like minimally invasive surgery and robotics. They've made some small acquisitions. They seek to compete more with the likes of Intuitive Surgical. Stock's trading a little over 19 times forecast earnings, and the Boston Scientific heart valve recall, the benefits were more accrued to Edgewood's Life Sciences than Medtronic. So it's more of a ballast style of very high quality investment in the portfolio. And Amgen, the most recent addition to the model portfolio, finished the month approximately flat after having a very strong start, and then as investors turned their minds to the election outcome and the prospects of policy risks, some of those gains have been relinquished. There's no change to our investment thesis. It appears that Amgen is a stock that's been overlooked, a pretty classic relative value style of investment thesis. Investors are unduly focused on pharmaceutical and bioscience companies that have the most promising COVID-19 treatment prospects, and Amgen, meanwhile, has languished. It's down about 10% for the year, despite very stable, solid fundamentals, trading at about a 13 times forecast earnings, in contrast with 21 times for the market, and paying a healthy dividend. So it represents compelling value, and there's really no change to the thesis this month.
Oh, Alpha, okay. Not a lot of news. The Department of Justice filed their antitrust suit, which was narrower than a lot of investors feared. So the suit is really focused on Alphabet's deals with handset manufacturers, so mobile phone device manufacturers, around their traffic acquisition arrangements. So, for instance, Alphabet pays Apple about $10 billion per year, so for the default on all iPhones to send all search traffic through Google. So that's what the suit is focused on. It could have been a lot broader. And the shares closed very near an all-time high last night at 1798, so very close to 1800. We believe they're still upside. Very persistent revenue stream from their core business, Google Ads, and they're investing in all sorts of great opportunities, from driverless cars to quantum computing to their cloud division, of course, which is number 3 as far as sales go, but a lot of growth opportunity. Qualcomm, another company running on all cylinders. Big revenue beat. They beat by about $1 billion last quarter. They're projected to earn $9 per share next year. And so they're trading about 16 times. And they also hit an all-time high, $151 last night. But they are the unrivaled leader in 5G. With Huawei essentially out of most markets, they are the go-to for the underlying infrastructure that's being rolled out really this year. And they make about 50% more per 5G phone than 4G phone. So we're going to see what we believe significant revenue growth in 2021 and 2022 on that 5G phone rollout. Only a few manufacturers offer them now. Apple's just with the launch of the iPhone 12 has a 5G capable phone, and of course Samsung was a little bit ahead. I think they've had a 5G for at least the last 6 months. Joe, you've got that. Yeah. And we think the Biden administration will continue to put pressure on China with relation to Chinese theft of IP, which should benefit Qualcomm. And that finishes the presentation. We're 10% cash, and here are our 9 core relative value holdings, with, of course, the BATS as supplemental, or, well, the BA as supplemental now, since we sold 10 cents. Very proud of our long-term track record, and happy to stick around for questions if anybody's left with us.
Thank you, Steve. A replay of today's webcast will be made available shortly after the conclusion of this event and will be emailed to you. Listeners with additional questions can contact myself or the team by phone or email as per the contact information on our website. And that does conclude today's webcast. Thank you all for joining us. We appreciate your time. Stay safe, everybody, and we look forward to speaking with you again. You may log out now.
Thank you.
Thank you.
Thank you.